Most people check their 401k or brokerage account and they wonder, is this market going up or down? And should I buy now or wait? It's stressful, it's noisy, and it feels like everyone's guessing. And if you're like most investors, you're probably glued to stock charts, red and green candlesticks, moving averages, price targets. It's the common playbook. But what if I told you some of the smartest investors in the world, they're watching something totally different? One metric, not hype, not headlines, that's quietly predicted long-term market returns for decades. Now, this isn't YouTube theory. It's a tool used by Nobel Prize-winning economists and major institutions. And yet, your financial advisor probably has never mentioned it. Today, I'm breaking it down. No jargon, no fluff, just real tools to make better investment decisions. Welcome to What the Pros Watch, our newest series here on We're Talking Money, where I'm going to reveal hidden metrics the pros rely on. So we're kicking things off with a really big one. It's the Schiller CAPE ratio. Let's break it down. CAPE stands for cyclically adjusted price to earnings ratio, and it was developed by Nobel Prize-winning economist Robert Schiller. Here's how it works. The traditional price to earnings ratio looks at a company or the S&P 500's current price divided by earnings over the last 12 months. The Schiller CAPE ratio goes a lot deeper. It divides price by the average of the last 10 years of inflation-adjusted earnings. Now, why does that matter? Because it smooths out a lot of the noise. Things like pandemics, recessions, one-time tax cuts, anything that distorts earnings in the short term. Think of it like this. It's the difference between judging a baseball player on last week's game versus their entire decade-long career. One gives you the hot streak, the other gives you the truth. And here's where it gets real. Historically, when the CAPE ratio is high, say above 30, future returns are generally weak, sometimes painfully weak. We're talking under 3% per year over the next decade. But when the CAPE is low, around 15 or below, future returns, they tend to explode. Think 2009 after the financial crisis. This isn't a timing tool, get that straight. It won't predict what the market does next week, but it's a powerful compass. It's a way to set expectations, manage risk, and avoid getting blindsided by so much optimism. So how do you use it? Well, when it's above 30, markets tend to be too expensive. That's time to reduce risk, maybe raise cash or diversify more globally. When it's between 20 and 25, that's a caution zone. You want to stay disciplined, not chase the market. Below 15 historically is undervalued, and that's when fortunes are built, if you've got the guts to act. So here in early June, the reading of the CAPE sits at around 36.5. That's well above average. If you're expecting 10% returns every year going forward, you might want to rethink that. Here's a real-world case study that might help. In early 2009, fear was everywhere. Banks collapsing, recession headlines. Everyone was running for the exits.
The signs were everywhere, but now it's official. We are in a recession. The research group that makes that determination made it today and said the recession actually started a year ago. But the question now, when will it end?
But the CAPE, it quietly told a different story. It dropped below 15, and if you listen to that signal, you could have tripled your money over the next decade. That's the power of valuation over emotion. The pros know it, and now, so do you. At OmniStar, we use tools like this, along with our 10 elements of wealth management, to help our clients cut through this noise and invest with clarity. So this is just one episode of What the Pros Watch. Coming up, we're going to dive into volatility signals, smart beta, institutional allocation models, and even the metrics that Warren Buffett swears by. So if you want the playbook the pros actually use, hit that subscribe button. And if this episode helped you think differently, tap like. It tells us to keep making more of this kind of content. And hey, if there's a myth or a metric that you want me to break down, drop it in the comments. We read every one, and we'll act on them every time we can. Investing isn't guesswork, but it's not simple either. You just need the right tools. And of course, someone who will tell you the truth. If this has been insightful for you, click or tap the screen to watch the next video in this series, or check the link in the description for our full playlist.